What's up everybody? Nate here. So over the last 2 years, we have seen some of the biggest booms in our economy and markets that we've seen in a very long time. The stock market has hit new record highs. The housing market has also exploded, and cryptocurrency and other markets all throughout the world are setting new records every single day. But here's the thing about those records. Nothing can go up forever. And right now we have inflation in the United States that is well over 7%. And everyone from markets to everyday Americans are starting to feel the heat from all of this inflation, as everything is starting to explode and is getting way out of control. So the Federal Reserve has now come out and said that they're going to start getting aggressive with inflation in order to lower it within our country, raising rates and pulling a lot of their economic stimulus. And just like that, inflation will suddenly just go away. Well, I'm here to tell you that the magic that the Federal Reserve believes it has is not real. This issue of inflation goes far deeper than the Federal Reserve just raising rates and hoping it goes away. And because of the last 2 years between money printing and low interest rates, the Federal Reserve may have set in motion one of the biggest financial and economic disasters of our lifetime. So today we're going to talk all about the Federal Reserve and why this inflation problem is not going away anytime soon. And while it may be way too late for the Federal Reserve to really do anything. But before I break all of this down, do me a quick favor and smash, hit, or destroy that thumbs up button below. And be sure to ring that notification bell too. That helps to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's talk all about what's going on with the Federal Reserve right now. So while Federal Reserve Chairman Jerome Powell hasn't directly come out and said when Federal Reserve is going to raise its benchmark interest rates up from 0% or by how much, many Fed presidents throughout the country have talked about what they think would be appropriate interest rate hikes for 2022. Atlanta Fed President Raphael Bostic says that we will probably see 3 or more rate hikes in 2022. Fed President of Cleveland, Loretta Mester, wants to accelerate balance sheet wind down in 2022 and raise interest rates even more. And Mary Daly at the San Francisco Fed says that inflation is going to get way worse before it starts getting better. So I guess we have a lot to look forward to. Now the current plan for the Federal Reserve is to start raising its benchmark interest rates starting in March or April of 2022. While this is all happening, it wants to start decreasing its balance sheet and asset purchasing on Wall Street. That means it's going to taper its quantitative easing program and raise interest rates in the United States. Now, according to their plans, here's what that would do. For one, it will decrease demand in the United States for just about everything. When the pandemic first started, the Federal Reserve dropped its benchmark interest rates all the way down to 0%. They wanted to incentivize people to go out and spend money because it was easy to get a loan. Not only that, but the federal government printed trillions of dollars in stimulus, meaning just about everybody was getting thousands of dollars for a long time. This was all free money, but in March 2022, all of that is going away. They now want to decrease demand. Decreasing demand will hopefully mean that people don't go out and spend as much, which is directly contributing to inflation right now. Because of the pandemic, we ran into a ton of supply chain issues, and we're still feeling those supply chain issues today. If demand is dropped though, this will hopefully give suppliers enough time to make more products and meet demand in the United States. And of course, on the other side of that is decreasing their balance sheet. So they have bought now trillions of dollars worth of assets on Wall Street. These were all treasury notes, corporate bonds, and mortgage-backed securities. So essentially, they're just gonna flip the money printer off here. And according to the Federal Reserve, doing those two things is just the thing that the United States needs in order to decrease inflation. That will eventually get inflation down to their target level of around 2%. And just like magic, inflation will disappear. But as you can probably guess, nothing is that simple. Just raising interest rates and stopping their quantitative easing is not going to fix inflation overnight. You see, inflation in the United States is a big issue. We've talked a lot about on this channel about how this is an issue for everyday Americans. When you have high inflation, the prices in your economy go way up. And according to the CPI or Consumer Price Index, the average price of just about everything has gone up by around 7% over the last year or so. What that means is something that costs $1 today is going to cost $1.07 a year from now. And it's putting a big strain on just about everyone in our economy right now. But this inflation issue is not just limited to what people are buying on a day-to-day basis. this inflation issue also has to do with the price of assets. We are living in kind of a historic time right now because every market that you can think of has hit a new record high over the last 2 years. Many investors and experts are calling it the everything bubble. Now, how exactly has the Federal Reserve contributed to this everything bubble? Well, 2 words: money printing. The Federal Reserve has printed trillions of dollars over the last 2 years in order to push up our economy, pretty artificially. And they did this because they started enacting easy money policies. What I mean by easy money policies is that for everybody in the United States, both investors and everyday Americans, it is super easy to get any amount of money. Money is pretty much everywhere, which means everybody is going to have it and everybody is going to start spending it. But this creates some seriously bad problems in just about every market. It means that markets are going to get pushed up by risky investments. And this is what we've seen on the stock market especially. Investors have been throwing their money behind risky assets for about 2 years now because they are investing on Uncle Sam's dime and not their own. But not only that, the Federal Reserve has directly contributed to Wall Street booming over the last 2 years. Their balance sheet is now around $9 trillion, which means they have poured $9 trillion into the stock market. And think about exactly what they're doing here. They're pouring money into the stock market to give to companies so that these companies can have extra liquidity to do whatever they want with. They can grow despite the economy actually failing. This creates riskier and riskier situations for businesses all throughout the country. And investors are able to invest pretty much however they want in whatever they want. It encourages spending, and it encourages spending for everyone, including our federal government. We've talked a lot about corporate bonds on this channel, but we haven't talked a lot about treasury bonds. A treasury bond is basically something that you can buy that you directly loan money to the federal government, and then they're going to pay you back with interest over a certain period of time. Well, the Federal Reserve has been buying these too, and has bought trillions of dollars worth. That's pumping trillions of dollars back into the federal government for them to spend however they want. So now not only are investors getting risky with their investments, but the federal government is getting risky too. We're starting to pass bills that we don't even know if we can fund yet. We're just passing bills because we know the Federal Reserve has bought so many treasury notes. The stock market is investing in companies that haven't even produced a profit and don't expect to produce a profit for a long time. In addition, mortgage-backed securities were another thing that the Federal Reserve has been buying in bulk. The Federal Reserve has bought around $470 billion in mortgage-backed securities. In 2021, the entire new homes market in the United States was valued at around $346 billion. So the Federal Reserve has basically bolstered the entire housing market in the US. But it doesn't stop there. They've also bolstered the stock market, improving it and pumping so much money into it. And they've also funded the United States government. Every market in our country right now is being funded by the Federal Reserve in mass. As you can probably guess, that's a big problem because what happens when that money suddenly disappears? Well, this is what the stock market is so worried about and why we've seen the stock market essentially tank over the last few weeks. Since the start of 2022, the stock market has done nothing but go down. This is mainly because investors are worried about inflation. Inflation bothers more than just them and their investments. It involves everything in our economy. So you're probably thinking, wouldn't it just be better to pull the band-aid now? I mean, bring back that quantitative easing and raise rates as high as you can. That way inflation starts to go down. In terms of inflation, sure, that would bring inflation down. It would bring it down pretty significantly because Americans aren't going to have any money. However, it would also bring down just about every market in the United States. For the housing market, if you start to raise rates too fast, and that pushes way too many people out of buying a home all at once. For the stock market, a lot of investors trade on margin. They can't do that if rates are super high. And because of all the securities on the stock market, market, indexes are going to start dropping heavily. And just in general, if inflation is high, people aren't going to spend money, which means earning reports are going to be down too. All of that could send us into a recession, but to be completely honest with you, it's worse than that. And at this point, raising interest rates and pulling a lot of their money printing is not going to be enough for the Federal Reserve to stop this inflation issue and stop our economy from tanking. You see, back after the 2008 crash, the Federal Reserve printed a ton of money. In fact, between 2008 and 2014, the Federal Reserve printed 3.5 trillion new bills. At the time, that was triple the amount that it had ever printed in its 95-year history. Today, we have printed way more than that. And even if the Federal Reserve aggressively raises its interest rates and immediately pulls all of the money from the New York Stock Exchange, well, that's not really going to matter. Those trillions of dollars are already out there. They've already been printed. And you know, this inflation issue actually could be stopped if the Federal Reserve decided that inflation at all was a bad thing. But remember, the Federal Reserve believes that 1 to 2% of an inflation rate is actually healthy. That's their target inflation rate. So they're going to continue to print money even after they stop their quantitative easing and raise interest rates. And think about what this means for our economy as a whole. We saw inflation in the 1970s and early 80s that was around 11 to 13%. That is nearly double what we're seeing today. And the Federal Reserve at the time decided that they were going to get super aggressive on inflation, doing the exact same thing the Federal Reserve wants to do now, raising interest rates and stopping a lot of their money printing. What that ultimately led to was, yes, lower inflation, but also rippling effects throughout our entire economy. In the 1980s, the average interest rate for a mortgage was around 17%. Because money was so hard to come by and because interest rates were so high, banks had to be extremely selective on who they gave a mortgage to. Not everybody could afford it, and that is going to mean our country today has some serious issues, and that's the fallout that we're facing in our country once the Federal Reserve decides to do more about inflation. In 2020 and 2021, it was easy to get a mortgage, but now in 2022, interest rates are starting to rise, and most buyers are able to afford a mortgage if the interest rate is between 3 and 5%. However, if interest rates continue to rise like they are, they could go up 5% plus. They could even reach 10, 11, or 12%. That means the wealth disparity in our country is going to be extremely lopsided. The only people who are going to be able to afford a house are the ones who can spend a ridiculous amount of money on it. The middle class and the lower class are going to be completely priced out of the housing market for a long time. Not only that, but the rich are just going to get richer in that type of economy, because you got to think about it. As all of this is going on, the ones who are going to be able to buy other assets like stocks and bonds and other real estate are going to continue to do so. They are the richest in our country. It's going to be a lot harder for people to buy those assets. So your billionaires and multi-billion-dollar companies are going to get increased in value. Like I said, the wealth in the United States is going to be way off for a long time. So the Federal Reserve faces a super tough decision come March. And to be completely honest with you, money printing by itself isn't the cause here. It's when you have way too much money, and a lot of these free money policies go on for way too long. If you have years and years of all of this money printing, low interest rates, and quantitative easing, then you're gonna run into long-term problems. This inflation issue is not going away when the Federal Reserve flips the switch. It's going to be lasting for several more years. The only way that this does not become a crippling moment for our economy is if somehow, some way, the American public and investors start pouring their money back into a lot of these securities. When the Federal Reserve ultimately exits the market, all of that money is going to disappear, which means that trillions of dollars that was flowing into the market is gone. So if investors can start putting up those similar numbers from their own pocket, well, then you could see markets start to stabilize without completely coming down. But ultimately, I just think there's not enough money for people to really start doing that. And as far as interest rates go, well, the only way to kind of fix those problems is to just keep on raising interest rates. But unfortunately, interest rates are going to get so high that that's going to hurt the housing market and just about every market that has to use loans. The majority of Americans are not going to be able to afford those types of loans, meaning that getting a loan and getting a mortgage is only going to be for the elite in our society. And the Federal Reserve can't stop printing money altogether because that actually helps the federal government to keep going. They're able to pay back all of their bills cheaper because of cheap money. As they print more, the value of money starts going down, which means all of the bills that they've taken on, those values go down too. The federal government is essentially paying off all of their debt with cheaper dollars. If it was the opposite, the federal government would basically dissolve itself in a matter of years. And at the end of the day, how do you think the average American is going to feel about being pushed out from building wealth and buying assets? They are not going to be happy, which means a lot of the political unrest that you're starting to see right now and objections against the rich and powerful in this country are only going to grow as that disparity gets bigger and bigger, which means the federal government is going to have to step in at some point and provide something to the general population of this country. And typically that means more money printing, which at the end of the day is only going to hurt us more. If businesses start paying people even more, that's going to hurt the entire country as a whole. Yes, in the short term, that will help people, but that ultimately means inflation is going to go up. And I just want to be super clear here. The Federal Reserve and the United States federal government had an extremely tough decision to make back in 2020. America was essentially failing. Nobody was making any money and the stock market was tanking. The Federal Reserve was kind of sitting on the fence. They had to ask themselves, do we kind of bail out the United States or do we just let everyone fail? If they just let everyone fail, then that's bad for them because now you have an economy that's tanking. Nobody is making any money. And chances are that administration is not going to be re-elected because you're basically saying that you're okay with going into a recession and that that's what's best for the country. So that comes down to what is the responsibility for the United States federal government? Is it their responsibility to make sure that everyone in this country has money and savings in order to protect themselves against a financial disaster? Or is that on the people? And if they don't have it, then they're gonna lose. The fact of the matter is that they didn't have it. Businesses didn't have savings. Americans didn't have savings. So the federal government and the Federal Reserve decided to step in and offer that liquidity for everybody, Americans and markets included. But the bigger issue here is how long they have been doing it. Some money printing can be okay if it's done the right way. However, the money printing from the Federal Reserve was not done the right way. They have created super bubbles in every single economy, and all of those bubbles are getting ready to pop. And that won't even be the end of it because interest rates still have to go up because inflation is so high. They have to keep constricting our economy and lowering demand even more, which means rates for everything are going to be impossible. It's going to be impossible for regular Americans to get assets and to buy things like a house. That could send our economy and our country into turmoil from a cultural and financial perspective. So unfortunately, it's not as easy as just flipping a switch and poof, the United States economy is fixed. Inflation starts going down. It is a lot more complicated than that. So in short, be careful for what comes next. But now I want to hear from you on this issue. What do you think about the Federal Reserve and their role in our economy over the last 2 years? Do you actually think that everything they've done has made our economy stronger, or do you think it's made our economy incredibly weak? Whatever your thoughts are, leave a comment below before you go. That is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from all over the country, our team puts together a free daily newsletter called Market Briefs, and you can subscribe to that for free by clicking that link below. And if you want to see more videos from me about what's happening in the business and financial world right now, I got another video for you right here, so be sure to click on that before you go.